Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Salt Lake City. Welcome to the show, Jerry Vinci.
Thank you. Thanks, Victor. Thanks for having me.
Well, great to have you here. Now, Jerry, you are deeply immersed in senior housing and everything associated with that. Excited to have this conversation. It's an area that we play as well. But maybe before we do, perhaps give a little bit of your backstory and how you got to this point in your journey.
Sure. Yeah. I have spent the better part of the last 20 years in senior living. I founded an organization called CCR Growth, which is a demand generation agency built exclusively for senior living operators. So we have an operator-facing side of our business, and then we have a capital-facing side of what we do, which is specifically for investors looking to get into the senior housing space, but might need to do some due diligence in terms of how those assets are performing in the market. And so I'm kind of focused on both sides right now.
I love it. Well, this is an area that, quite frankly, it's got both headwinds and tailwinds. And when I look at senior housing, I think of it through the lens of designing a product for a specific customer. Even though from a healthcare standpoint, at far enough a distance, the needs might look the same, they're very, very, very different products and different positionings of products in the marketplace, depending on location, depending on affluence, depending on copay, all these different things. So how do you segment the market? Are you looking at it in terms of market rate? Are you in terms of subsidized? Are you thinking big box, boutique? There's so many different ways to slice and dice this.
There really are. And I think from an investing standpoint, it really just depends on the level of risk that you want to take on, because you've got these smaller communities that are, anywhere from like 40 to 100 units valued at, say like 2 million to 12 million. Then you've got the bigger boxes that are significantly higher than that. But like you're saying, the demographics are really what tell the story. That's depending on what market you're looking in. You have to consider, and this is why senior living is so complex, is because it's not just a commercial real estate asset. It's an operating business on top of that, and a complex one at that. So you're looking at the demographics of the area. You're looking at the labor market. You're looking at competitors in the market, and then future growth of that space. So there's a lot of things to factor in when it comes to that. And then even just like you were saying, the different care levels from independent living, assisted living, memory care, skilled nursing, every one of them presents its own set of challenges for sure.
Absolutely. So when I think about, at one end of the spectrum, there's the boutique model, which quite frankly, in my view, if a 16-bed home doesn't work. Just the economics are not there. Just like a 16-room hotel doesn't work. It doesn't work because the scale isn't there, and you need all of the functions. So all the ratios are out of whack. So there's a break point, probably around 80 beds, north of 80 beds, where things start to work, where you can afford a director of nursing, you can afford an executive director, all of the things that you need to have a functioning community. It's still a complex business because staffing is difficult, and that's probably the number one issue, is getting the quality of care. And then it doesn't matter whether you are earning $40,000 a year or you're a billionaire, your healthcare needs could be identical. They could be exactly the same. And so the cost of delivering those needs would be theoretically exactly the same, irrespective of your income. So when you look at segmenting the market, when you take out the chandeliers and the underwater treadmills and all this other stuff and just look at it from a care standpoint, what is that base cost that is really required, at the AL level, or perhaps at memory care? Obviously, it's, acuteness of care is a function. But when you look at this, what are those base costs that are immovable objects?
In terms of an investor looking at this space, what would be those?
Yeah. So, if someone comes to you with an investment thesis that says, I'm going to build a home and I'm going to get, $3,200 a month per bed in rent, I know in my mind, I'm going, there's no way in heck that's going to pencil. That's just not going to work. I don't care who you are. That's just not going to deliver an acceptable level of care. There's going to be way too many corners cut for that to be even compliant, if let alone acceptable. So do you have a sense for where the market thesis breaks down?
I think for me, and this is kind of where the real estate market drops the ball when it comes to senior living, is it's not so much what you're talking about. I think it's more of the actual systems. It's a systems problem within these communities. I think a 16-bed community could work if they had proper systems in place. A lot of the communities don't, and that's the challenge is they don't have a way to generate consistent, reliable results. So a lot of times if someone's investing in senior living, they're looking specifically at a number like occupancy, for example. They see 90% and they're like, yeah, this is a great asset. It's functioning well. But what's really going on behind the scenes is they don't realize that that 90% occupancy, 25% of those residents are moving out within the first 90 days. So how are they replacing that? Or what's their, the historical trend with their occupancy? Is it going up, down, staying the same? We're continuously looking at the systems that they have to ensure that whatever the asset has produced, it can keep producing over time. That's probably the biggest benchmark, I think, and partnering with people who understand how this industry works and can see those if those systems are in place and if they're working or not. I think that's probably one of the most valuable pieces of the investment puzzle right now.
I agree with that. And I think it's important to maybe break down the resident tenure in the different product classes. For example, in active adult independent living, you could have quite a long resident tenure, 8, 9, 10 years. That's not the case in skilled nursing, certainly not the case in assisted living, maybe a little longer in memory care, but these are much, much shorter tenures.
Yeah, I mean, you're looking assisted living is what, 12 to 18 months on average. And like you're saying, independent living is far longer. So the length of stay is going to be a big factor in terms of profitability as well. If you're having to turn those rooms every couple of months versus if you have a resident that's staying in there for multiple years. I mean, the LTV on a resident is so much higher for independent living than it is, say, for memory care or skilled nursing, where there's continuous changeover.
Absolutely. And then the other factor, of course, that's very much a moving target is stability of the employment base and what is the caregiver ratio. In some of these larger communities, the caregiver ratios can be quite high. 16 to 1 during the day, 32 to 1 at night, sometimes even higher. I mean, if you're that poor bugger that needs help at 2 a.m. to get to the bathroom, man, you're waiting a long time, right?
Yeah.
There's just, and so is that even an acceptable level of care? So are you staffing for the economics, or are you staffing for the required level of care? And that factors very heavily into the entire thesis for the project.
That's been a major challenge with staffing as well. There's about a 50% turnover rate year over year in caregiving, and over 70% turnover rate in the dining staff. So there's a lot of turnover happening, which recruitment is a big challenge in this space, just because there's such a shortage in care workers already. And in the next decade, we're going to need probably an additional 800,000 plus. So I'm not exactly sure where those are going to be coming from.
Absolutely. And so the picture that you're painting here, I think, is an accurate one, which is because we tend to think of these investments as very stable investments with mailbox money coming in like clockwork. And the fact is there's such a high degree of turnover, both in the resident population and in the staffing, that it would be silly to look at them as a stable money machine because there's so much variability month to month.
Absolutely.
So, and yet, even with that, properly designed, the margins can be strong. They're not always, but they can be strong, properly managed. These can be great businesses, deliver great service to clients and great returns to investors. But they can also do the opposite, as even some very large private equity firms have discovered when they fell on their face because they didn't really understand the business.
Yeah, it's unfortunate that we've seen that quite a bit. But it's very interesting to watch investments in this space. I think there was about a 45% increase in M&A, mergers and acquisitions, in this industry in the last year, and 86% of institutional investors, I think, said they were looking to put more emphasis on the senior housing industry in 2026. So it's clearly a space where people are starting to pay attention.
Well, absolutely. I mean, if you think about it, you probably know the stats better than I do. I'm going to say that the average age of someone entering assisted living is around 85 years of age, and the oldest baby boomer today is not 85. So
Correct.
the wave hasn't really hit yet. Yes, the baby boomers are retiring, but the wave is really just starting to hit senior housing, and a lot of the capacity that's been built into the market was in anticipation of that, right?
The boomers, yeah, the youngest boomers turn 65 by 2030. The challenge, so the 65 plus population by 2044 is going to increase by 35%, but the 85 plus population is going to increase by 111%. So it's going to more than double. And obviously that's because our life expectancy has significantly increased compared to previous generations. So the challenge with that, we've got this major demand upswing, but we've got supply that's literally stagnant right now. We are producing roughly less than 25% of the units that actually need to be built. So by 2030, there needs to be an additional 800,000 units built. And we've built about 25% of that. And then from 2030 to 2044, it's roughly about 100,000 units every year to match demand. So that's the challenge right now. I think it's just construction lending has kind of dried up somewhat since 2023. So a lot of developers are just, scratching their heads trying to figure out how they're going to meet that demand.
Is aging in place a viable alternative?
It is until it isn't. It is until someone's no longer. That's not an option. So that's the challenge too with boomers. I mean, they're staying in their homes a lot longer. They've got over 50% of all real estate wealth, but then like your audience, typical investors, I mean, they're saying there's no housing available in my market. Why is that? It's because they're not leaving. The boomers are staying and they're holding on to their properties, and more than 50% of them actually own their homes outright. So there's a lot of opportunity there once that change starts happening.
Well, Jerry, definitely want to have you back on the show, dive into this deeper. If folks want to connect, if they want to learn more in the meantime, what's the best way?
Yeah, if they want to learn more about this industry, I have two places they can check out. If they want to learn more about the operator-facing side, they can visit our site, ccrgrowth.com. And if they want to learn more about the capital-facing side and how we do due diligence on market performance, they can check out nordonadvisory.com. That's NORDON advisory.com.
Terrific. Well, Jerry, great to connect. And for the listeners at home, you definitely want to connect with Jerry at ccrgrowth.com and Nordon Advisory. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.